In this session, we will delve into risks, transaction security, and price determination in M&A transactions. During the transaction, the M&A journey is riddled with potential pitfalls. These challenges, if not preemptively addressed, can derail the most promising of deals. Let's delve into its intricacies. Material adverse change, MAC, or material adverse effect, MAE. Material adverse change clauses address unexpected significant changes or impacts on a business, which can influence the agreed terms or even halt a deal. Essentially, they focus on major events that negatively affect the target company's business, assets, or financial health, such as a sudden decline in customer base, legal or regulatory adjustments, or unforeseen economic setbacks. To ensure clarity and protection regarding material adverse changes or effects, consider the following. Precision in definitions. Both parties need a clear consensus on what events or situations qualify as a material adverse change, specifying particular circumstances or benchmarks. Delineate remedies. Before any such adverse events transpire, parties must have a predetermined plan, whether that involves renegotiating terms or walking away from the deal. For example, a buyer agrees to acquire a target. However, post-agreement, a new regulatory policy severely impacts the seller's primary revenue stream. The contract should clearly define what constitutes a material adverse change. If such a situation arises, the contract could allow the buyer to renegotiate the deal or walk away without penalties. Financing failures. Securing financing is a crucial step in M&A transactions. The volatility of financial markets, shifts in interest rates, or a lender's sudden reluctance can jeopardize the buyer's acquisition financing. To prevent such failures, consider the following. Sturdy financing commitment. Before proceeding with a transaction, ensure that there is a robust financing commitment in place, not just a letter of intent. Backup plans. Always have alternative financing options. In situations where the primary funding source fails, secondary options can save the deal. Flexible terms. Consider clauses that permit the renegotiation of terms if the financing environment changes drastically. For example, a buyer plans to pay a seller using a loan. However, due to an unexpected financial crisis, the bank retracted its loan offer to the buyer at the last minute. To prepare for such situations, the buyer should have a strong financial commitment in place from the bank, not just a preliminary letter of intent. Additionally, backup financing sources should be identified, and terms allowing renegotiation in case of drastic market changes should be included. Change in recommendation agreement makes sure the sides avoid extra problems. In M&A transactions, the purchase price is central. It represents the exchanged value. Determining this price involves considerations like acquisition value, price recalculations, and related remedies. Components of the acquisition price. When determining the acquisition value in M&A transactions, it goes beyond just the stock purchase mentioned in the contract. The acquisition by thorough due diligence are of the essence.